Hello and welcome to Pro Trader Strategies Market Commentary for Friday, October the 20th. Well, we all survived the 30th anniversary of the stock market crash of 1987. Anyway, my name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Having all that out of the way, let's get it on with some economic data. Well, not a whole lot to talk about on that front. We do have Canadian economic data, so you want to hear that? Might as well, because we don't have a whole lot of other news to talk about there. Their CPI came in at 0.2%, expected to be 0.3%, but the one thing that I really wanted to talk about is their core retail sales came in at negative 0.7%, was expected to be a positive 0.3%, so a bit of a pullback there and much more than expected on that front. Then here in the United States, we got existing home sales came in at 5.39 million units, expected to be 5.3 million units. So a lot better on the front of existing home sales. Could be in the fact that people are starting to realize some interest rate increases would affect those overall financing of those types of things. I know that the mortgage brokers are out there kind of pushing that for their sales, that interest rates are going to continue to go up and it's going to be very difficult to get interest rates as low as they are right now. So keep that in mind as well. And then later on today we have Fed Governor Janet Yellen speaking. That's not until like 7:30 p.m. Eastern time, so not going to be anything to really affect the market, and the markets will probably have forgotten about that if she says anything major over the weekend. So on to the overall markets. We've got crude oil right now down just slightly, but still above the Fibonacci level that I've been talking about, and that number of 51.45-ish, 51.43. I guess we're 2 ticks below that right now, but it has been acting as a buoy for that market, and I continue to see this market kind of trade around whether or not it bounces above and below this Fibonacci level, but to fill in this low volume area. I think it's going to kind of fill that in there, so we're going to see some volume traded in and around that area, but don't really see it going much higher or much lower right now, because we're kind of in a ho-hum kind of economic state where people are using gasoline, distillates are getting used in the manufacturing sector, but we're not seeing that real fast ramp up. So I don't see it really spiking up in the 60s and especially up into the 70s, but to kind of stay somewhere between 50 and 60 for the foreseeable future anyway. Gold futures coming off again today, but it's really fighting against this 61 fib level, which is right around that 1282 area, which are 1280 area where we're kind of at right now. I expect it to go down and test the 1250s. So, but I need to get below this fib level, which is really acting like more of a support than what I was expecting. I thought it would kind of have a tendency to really kind of push through that, especially with the equities continuing to move higher. A lot of the earnings that we're starting to see are pretty decent. So to me, it seems like equities are going to creep higher, and gold should come off due to the people pulling money out of gold and placing that into the equities. It is being reflected in the bonds. Remember, I talked about the bonds really can't go much higher than this because the rhetoric coming out of the FOMC, for lack of a better phrase, has been that they are going to continue to increase interest rates. I think it's going to be more next year than it is this year, but we're seeing the bonds come off quite a lot today, almost 1.5 points. It was 1.5 points just a minute ago, getting a bit of a bounce. But again, I don't really see it kind of breaking out of definitely between the value area high and the value area low anytime soon. very low implied volatility in there. It's kind of steady as she goes, but it should probably stay somewhere even within this area here between my two cursors there. So this is the comfort zone for the bonds. That's where the most time and volume's been spent, and where the most transaction has happened. And usually when you kind of get stuck in the mud in those types of situations, because that's where the longs are happy and the shorts are happy, because everybody's right where they entered the market, and it kind of has a tendency to calm down or in and around that. Now on to the Dow Jones Industrial Average, up over 100 plus points. And of course, if we're up at all in the equities, that means it's a new all-time historical high, and we're seeing that reflected here in this market, up another 115 points, and very near the highs of the day in the Dow. Then on to the NASDAQ, bit of a lagger compared to the bonds, or sorry, compared to the Dow Jones Industrial Average, but a really big comeback late in the day yesterday for all the equities. When we were talking, it was looking like a confirmation to the downside. Now we're not getting that move to the downside, and the continuation of that today. The NASDAQ up 16, almost 17 points right now as we speak, and really bouncing its head up against the value area high here. E-mini S&Ps moving higher by 8-9 points here, very near the highs of the day and piercing above the value area high. It's actually kind of drawing that value area high up with it, but we're starting to see this continue up. Now, I was looking for the equities to have a bit more of a pullback, give us some opportunity to get in again, but it is moving higher, not giving me that pullback to find some value in the overall markets. And when we're seeing this market move higher like this, we're going to really see the VIX come off. And I don't have a chart of the VIX today, but I'm sure it is coming off quite a bit. So let me just pull up one other chart. I'll pull up the old eBay chart, and we'll throw the VIX in there just to see what the VIX is doing, because I haven't checked in on it today. But I'm sure it is coming off, as you can see here, back into the single digits as we were yesterday. We've got a big spike in that VIX yesterday, which was kind of promising, and for a person who likes to sell premium like myself. But again, when those markets rebounded late in the day, the VIX just cratered on it. And today coming off again as the equities are moving higher. Let's take a look at the 30-minute chart of the E-mini S&Ps. You can see overnight we got the big rally. Basically, as soon as the markets open, we got a big massive rally. And a lot of times what we'll see in that is the overnight inventory gets very long, so the day session comes in and kind of slams down on it. But because that overnight session was so much dramatically higher at 25.71, it seems like the intraday move is to try and print that on this Friday. So it looks like that's what's on the docket for these guys. That's going to be the target, is to print 25.72. So that could be a place to have your out on any longs that you are trading on a day session. But you can see this is what we were talking about yesterday when we were talking the market off the open, just kind of a steady rally right into the close to finish higher on the day there. All right, so let's talk about a couple of things that I've done. UAL, looks like we've kind of bottomed out here. They came out with earnings. They crushed their earnings estimates. I mean, as you can see, they came out with the estimates were $2.05. They came out with better than expected at $2.22. So one would expect that market to blast off. You remember I had an earnings trade on there, and I got out early, which was nice because I would not be happy if I waited to the end of the day. But today we're looking like we got a little bit of a at least buoyancy happening, where some people are coming in for that value. Now I'm looking at the chart here and see that there's a couple bottoms here, and that afforded me to get in at around the 55 area, which is the next strike down. So I did this both in my IRA and in my margin account, but in my IRA, because it is so margin intensive, remember I just created a defined risk strategy in there. But having said that, I made it pretty wide in order to create that synthetic naked short in a sense. So I went into the November, which expires in 28 days, so right inside my wheelhouse for this type of strategy, and sold the 55 puts and then bought the 45 puts to define that risk for 52 cents in there. Now over onto my margin account, I went in, just sold the November 55 puts naked for 55 cents. So well below this support area, and if it gets down here, I think I'm still going to be all right. I don't think it's going to go that much lower. If we threw up a Fibonacci chart here on the sorry, let me try and find it. If I can throw a Fibonacci chart on here before the end of the day, then I can't seem to find it real quickly, so I'm going to skip over that. But the Fibonacci level is coinciding right around this 47.5 area or 57.5 area, so I'm going to be below that. I think I'm pretty safe on that front. So that's the trade I've done. The other thing that I'm kind of looking at right now, and I have a working order to get out of it, is my Nike long call spread, and I am long the 47.5 calls and then short the 55 calls in Nike. It is trading very close to 50% of my max profit on that one, so I have a working order in there. It's about 10 cents away. It was about 10 cents away. Now it looks like it's about 12 or 13 cents away on the Nike trade. But looking to get out of this one as well. We've got a nice move higher today, and if we get any closer to these highs, I'm going to be probably looking to be getting out of this. So this was the idea with this one. We talked about this with the bottom here. I thought it was going to move back up to the value area, despite the fact that my defined risk is up here at the 55. I was not sure that it would get up that high, but I was pretty sure that it would at least get to the value area, the point of control where the most time and volume spent. That's a magnet for it. Thought it would come up there. That's what's happened, and therefore that's why I'm very close to being able to get out of this for 50% of my max profit. So looking to do that sometime today. Like I said, I have a working order in my IRA, and then usually when I get executed in that one, then I go over to my margin account and kind of play around with that. I like to take a little bit more risk in my margin than I do my IRA for the most part. So that's all I've done today. That's about it. Today's webinar is going to be on the long call calendar, you guys, and that's a really good one, especially for something after earnings. With UAL, we didn't get that volatility crush like we usually see, like with Nike here. You can see volatility just crushes out of Nike, whereas in UAL, the reason why I put this trade on as a short is because it still has high implied volatility percent. It's above 50, and usually after earnings we get that volatility crushed down to basically the lows. But as you can see in the past, UAL has not necessarily done that, but it does have a tendency to take a few days for all that volatility to come out of there. So that's what I'm expecting in that one as well. So long call calendar, good one for low implied volatility after earnings, because we can start selling some premium against that, and we have that long duration for directional assumption to the upside. And I'm going to show you how to set that up so we can increase our probabilities of success, lower our cost basis on that, so we can have it for synthetically the cost of the strike that we have it at. And I'll show you how to do that in today's webinar. So check it out at protraderstrategies.com. And if you can't take that, take it easy.